Good morning, everyone, and welcome to the CABS Benefits Information Session. Today's session will cover the topics of health insurance, life insurance, TSP, FSA, long-term care, and information on all retirement systems. FEHB plan types. There are a variety of federal employee health benefit plans to choose from. We have listed a couple of those below for you to take a look at. Those will include your fee-for-service plans, your health maintenance organizations, better known as HMOs, your consumer-driven health plans, and your high-deductible health plans. For detailed information on those plan types, we have provided a link here. You just want to click on that link, look for the plan types to the left, and you'll get further information that is more beneficial to your personal needs. FEHB enrollment and allowance eligibility. Hey, what do I have to do to be enrolled in FEHB? You basically have to be a permanent, full, and part-time employee. The temporary, intermittent, or seasonal employees, you are eligible if you are working or anticipated to work the 130 hours or more per month for more than 90 days. The agency pays the full premium allowance for qualifying temporary, intermittent, or seasonal employees just as if those employees are permanent full-time. The agency pays prorated premium allowance for permanent part-time employees. For temporary, intermittent, or seasonal employees who work less than 130 hours, we are not totally excluding you from this huge incentive. We are basically saying that you are eligible to participate in the FEHB after 1 year of service, and that you would basically have to pay that full employee and agency portions of the premium. FEHB enrollment options. There are currently two types of enrollment, which include the self and the self plus family. The self plus one enrollment is not currently available for you guys, but it is new for the 2015 open season, and that will become effective in January of 2016. Usually, we do not allow the dual enrollment. Dual enrollment, what is it? It's basically when an employee or an eligible family member is covered under more than one FEHB enrollment. It is only allowed when an enrollee or a family member would otherwise lose coverage. FEHB enrollment opportunities. There are 3 opportunities for you to enroll in, change enrollment, or waive your FEHB. Those 3 instances would be during the first 60 days of your initial appointment from coming on board, during our huge annual open season that everyone gets super excited about, within 31 days before or 60 days after a qualifying life event. What is included in those qualifying life events? We basically say, if you get married, if you get divorced, if you have a child, the loss of your spouse's health insurance coverage and you need to pick up your own, moving outside of your HMO's coverage area, all of those are considered qualifying life events and allow you to change. To select the plan type, change enrollment type, or waive FEHB during your enrollment opportunities, you must submit the SF2809 form to us at gsacabs@gsa.gov mailbox, or you can do it independently on Employee Express. So with the Employee Express option, because you're doing it independently, we do ask that you notify our office and provide us with a receipt to say that everything went through successfully so we can update our system, and also we can put that piece of document into your official personnel file. FEHB premiums and premium conversion. This slide may look like a foreign language to all of you. You may not know exactly what I'm talking about, so I'm just going to give a brief background to that option, and if you have further questions, feel free to contact our office, or you can go online and find out more details that may be more beneficial to your specific scenario. So basically, for most employees, the government contribution equals a little over 70% of the total premium. The premium conversion is basically when your payroll contributions for health insurance are deducted before taxes. It is automatic unless you decide to waive this pre-tax option, and waiving the option gives you the ability to cancel your health insurance without waiting for an open season or one of those qualifying life events that I previously discussed. We have provided a link here that will basically take you directly to that form to waive the premium conversion. And like I said, if you need more details on that, we're more than happy to assist. FIB overview. FEDVIP is basically the acronym for Federal Employees Dental and Vision Insurance Program. FEDVIP provides extra insurance beyond any dental and vision coverage provided in FEHB. Permanent, full, and part-time employees are eligible. Temporary, seasonal, and intermittent employees, unfortunately, are not, and you are excluded from this option. I'm so sorry. But the same enrollment opportunities as FEHB, qualifying life events, etc. The plans include the self-only, the Self Plus One, and the Self Plus Family coverage. The premiums are withheld on a pre-tax basis. To enroll in dental and vision plan, we ask that you do this independently. Our office does not service this option, so basically you would go to the www.benefits.com website, or if you would like more personalized attention to ask questions or such, you can go to that one. You can call that 1-877 number, and you would basically enroll into those options. For the dental and vision, I'm basically going to give you a little more details in depth on both of those. For the dental, there's a minimum of 6 dental plans to choose from wherever you live. The premiums can vary by coverage area. The routine basic services like those exams and those cleanings that you have to get yearly, those are covered 100% when you use an in-network dentist. All of the plans cover orthodontia, with some with no waiting period at all. For the vision, there's only 4 vision plans nationwide to choose from. The routine eye exams are covered. Each plan covers your choice of glasses or contacts, whichever is your preference. And it also includes those huge discounts on laser eye surgery, which is a huge savings to most. FSA Feds Overview. FSA Feds is the Federal Flexible Spending Account Program. This is a huge incentive to those who choose to enroll in this. A tax-favored program that allows employees to pay for eligible out-of-pocket health care and dependent care expenses with pre-tax dollars. For example, an employee in 28% tax bracket puts $500 into FSA. That employee is now able to use that $500 for eligible expenses, and they only see the reduction in take-home pay of, guess what, $360 due to tax savings. The eligible employees can enroll in FSA Feds each year during the federal benefits open season. Open season enrollments are effective January 1st of the following year from which you enroll. For those of you who are already enrolled in FSA, this detail that I'm about to say is very important to you. Those enrollees must re-enroll each year to continue participating. So you have to be sure to pay attention to that. FSA Feds types of accounts. I'm just going to give you a brief overview of that. Also with this, you can go to the FSA Feds website and also find those details that are more to your personal needs. FSA Feds offers 3 different flexible spending accounts. Those will include your healthcare flexible spending account, your limited expense healthcare flexible spending account, and the dependent care flexible spending account. For the HCFSA, you have a minimum of $100, a maximum of $2,550, and that includes a rollover of $500 per year. That can be spent before payroll deductions are taken out. For the limited expense healthcare flexible spending account, the same provisions as noted above for the HCFSA. You also must be enrolled in a high deductible health plan with health savings account, only for dental and vision expenses that meet IRS definition of eligible medical care. And you can further research that. For a dependent care flexible spending account, you have a minimum of $100, a maximum of $5,000, and you also have that grace period through March 15th. And this can only be spent after payroll deductions are taken out of your check. I'm now going to pass the presentation over to my coworker, Shamika Cox, who will go over the FEGLI overview.
Thank you, Keeley. Hello, everyone. I will be going over the FEGLI overview. You are automatically enrolled in Federal Employee Group Life Insurance called FEGLI, Basic Life upon your initial appointment. There is a payroll deduction for Basic. Basic may be waived if you choose to. If you want additional coverage, you may elect Basic. You will pay the full premium for any additional coverage. Now you have 31 days before to 60 days after a qualifying life event to make any changes to increase add options to your plan. The only FEGLI qualifying life event are marriage, divorce, death, and the acquisition of a child. Transferring to a new position or agency is not considered a qualifying life event. There is no regular open season. However, you can enroll 1 or more years after waiving FEGLI without a qualifying life event if you pass a physical. You may cancel FEGLI at any time without a qualifying life event. Beneficiary Order of Precedence. You do not have to designate a beneficiary for your pay and benefits, but if you don't, there will be a legal order of precedence stipulates that beneficiary payments will be made as follows. To your widow or widower, if your widow or widower is deceased, to your child or children with the shares of any deceased child distributed among the descendants of that child. If none of the above, to your parents in equal shares or the entire amount to your surviving parent. If none of the above, to the executive or administrator of your estates. If none of the above, to your other next of kin under the law of the state in which you live at the time of your death. I will now be switching the presentation over to Sharon Fox, who will be going over long-term care.
Hello, everyone. Again, my name is Sharon Fox, and I will be going over long-term care and the CSRS retirement system. Long-term care providers can assist with daily routine care you might need that is associated with everyday living, such as bathing, eating, dressing, and other things that we take for granted. You might ask, why would someone need long-term care? Well, you could have a family member that's in a car accident or have suffered a stroke or other disabling conditions. The best time to consider long-term care is before you need it. It is also important to remember that long-term care is age-driven. That is to say, the younger you are when you sign up, the less costly it will be, and you are protecting your savings and other assets. Who qualifies? Federal employees, annuitants, active and retired members of the armed forces, and qualified family members, which include your spouse, domestic partners, parents and parents-in-law, and adult children. The Federal Long-Term Care Insurance Program is sponsored by the U.S. Office of Personnel Management, offered by John Hancock Life and Health Insurance Company, and administered by Long-Term Care Partners. Finally, there is no guarantee of approval for coverage. There are certain conditions or combinations of conditions that may prevent approval for some individuals. In order to determine if you do qualify for coverage, you must first apply. Now moving on to the CSRS Retirement presentation. The following slides contains information that I hope will be beneficial to you all, and I ask that you please read the disclaimer statement shown on this slide. The next slide contains information regarding CSRS as follows. If you are a CSRS employee, you are not subject to Social Security withholdings. You pay into the Social Security system. In 1983, Congress passed a law that brought Social Security coverage to federal employees. While Congress was creating this new federal retirement system, CSRS had an interim period called CSRS Offset that applies to individuals with a break in service greater than a year with 5 years of creditable service as of 12/1/1986. The FERS system went into effect on January 1, 1987, and Nancy Keating will be covering that in another portion of the presentation. Creditable CSRS service includes CSRS contributions that were withheld and not refunded, FICA, which you have the option to buy this time back in order to receive credit towards your annuity, CSRS contributions that were withheld and refunded to you. Military, you also have the option to buy this time back as well in order to receive credit towards your annuity. There are several instances where military service buyback may apply to an employee. If you have served in the military, Coast Guard, or other organization listed on the military service slide and have an honorable discharge. Therefore, if either FICA, military service, or if you received a CSRS refund applies to you and you wish to have that time credited towards your annuity, you have an option to repay that amount in full prior to retirement. And there are also several repayment options available depending on your retirement date. If you have questions or concerns about creditable service for buyback purposes, we will handle those issues on a case-by-case basis. Also, any unused sick leave is creditable towards your annuity, but not towards your retirement eligibility. This slide lists several types of CSRS retirement categories that include voluntary, optional, regular, and other types as listed on the slide. The next 3 slides contain information regarding the minimum age and service requirement for voluntary, optional, regular retirement, early optional, and discontinued service, requirements under CSRS, and the last one in this group is retirement based on disability. Deferred retirement. You may be eligible for deferred retirement under CSRS. The minimum age requirement is 62 with 5 years of creditable civilian service. Listed on this slide are the rules that also apply. The CSRS annuity formula shown on this slide is also on OPM's website, and that site is listed at the end of this presentation. The reductions to CSRS annuity slide provides several reasons that will reduce your CSRS annuity on a permanent basis. Survivor benefits elections. There are several options associated with survivor benefits for married and unmarried employees. We have listed the survivor benefit elections associated with your marital status on this slide. A few other factors that may affect your eligibility to retire include leave without pay in excess of 6 months per calendar year. There's also what we call WAY, which stands for when actually employed, also known as intermittent time. You are getting credit for actual time worked. This is also different than working on a part-time schedule. Lastly, the best recommended days to retire for CSRS employees who retire under a regular voluntary retirement are the last day of the month. Your annuity will commence on the 1st of the next month. If you retire on the 1st, 2nd, or 3rd day of the month, your annuity will commence the next day. However, if you choose to retire on the 4th or any other date, you will be losing pay because there's a period of time from the 4th until the end of the month that you are not being paid by your agency, so you will not be paid by OPM. For FERS employees, it is simple. It is recommended that you separate on the last day of the month so that your annuity commences the next day. And again, Nancy Keaton will also be covering this in her presentation of the FERS FERS retirement segment. Thank you for your time, and I now turn it over to Nancy Keaton.
Thank you, Sharon, and hello, everyone. The FERS retirement system is a sort of a three-legged retirement plan where FERS employees receive a smaller monthly annuity than they would under the CSRS program. They also receive matching from their agency on any TSP contributions that they may have made, and they receive Social Security benefits because they have been paying into the Social Security system. The initial FERS system was for employees hired between January 1st, 1987 through the end of December 2012 with no prior federal experience. And as you can see on this slide, employees contribute 0.8% of their after-tax salary to the FERS retirement fund if they were brought in under that initial FERS plan. Congress revised the program in 2013, and so employees hired in 2013 with no prior federal experience are covered under what's called the FERS Revised Annuity Employees, FERS-RA. And you can see that the employee contribution portion increased from 0.8% to 3.1%. And then in 2014, Congress further revised the program for those employees hired on or after January 1st, 2014 with no prior federal experience. They are covered under the FERS Further Revised Annuity Employees, FERS-FRA program. And again, the employee contribution rate crept up to 4.4%. FERS creditable service is very similar to CSRS creditable service. You have your covered service, also known as your paid or contributory service. You have non-deduction service, which is also known as FICA. This is different than CSRS. Here with the non-deduction service, employees who were covered under FERS prior to January 1st, 89, they can receive credit for that service as long as they make a deposit. Any employment on an intermittent or temporary basis after January 1st, 1989 is not eligible for FERS creditable service, meaning that you cannot use it to apply eligibility for FERS retirement, nor can you use it in your annuity computation. Another type of FERS creditable service is refunded service, in which you worked for the government and then left and then came back. When you left, you got your FERS contributions refunded to you. When you come back, if you make a deposit, you can use that for calculations in your annuity. And finally, just like CSRS, military service with discharge under honorable conditions is creditable under FERS. So for unused sick leave, just like with CSRS, it can't be used to establish retirement eligibility, but once you have that retirement eligibility, 100% of any unused sick leave can be used in the annuity calculation. The types of retirement under FERS are, again, similar to CSRS. You have the voluntary, also known as optional or regular retirement. You have early optional or discontinued service, disability retirement, deferred retirement, and that special provision for a few group of employees. Under the voluntary retirement, though, there is a option for minimum retirement plus 10 years of service, also known as MRA plus 10, and we are going to cover that in just a minute. So for your voluntary retirement, the minimum age that you can retire is 62 with 5 years of creditable service. If you have 20 years of creditable service, you can retire at 60, and if you have 30 years of creditable service, you can retire at your minimum retirement age. The chart on the bottom of this slide shows the minimum retirement age. So for instance, if you were born between 1953 and 64, your minimum retirement age is 56 years old. The minimum retirement age plus 10, we just mentioned that MRA plus 10. It requires 10 years of service, 5 of which must be civilian, and you must have reached your minimum retirement age based on your year of birth. You have to be in a FERS covered position at separation, and you can't be entitled to an immediate unreduced retirement annuity. That means if you are eligible for voluntary retirement, you can't instead go out on an MRA plus 10. The annuity considerations for going out on the MRA plus 10, if you have, if you're below age 62, are pretty significant. Your annuity is reduced on a permanent basis by 5% per year under the age of 62, and it's prorated per month, unless you have 30 years of service, or you wait until you're age 60 with 20 years of service. The early optional discontinued service, there are actually 2 different types here. The early optional is typically for major agency reorganizations that is approved by OPM, and discontinued service is due to an involuntary separation. Also, examples there would be if your agency moves to a different location which is outside of your commuting area. However, you're not eligible for discontinued service retirement if you decline a reasonable offer, which is defined as a written offer of another position in your agency and commuting area for which you are qualified, and which is no more than 2 grades or pay levels below your current grade or pay level. Disability retirement is a little different than under CSRS. With CSRS, you have to have served 5 years of creditable service. With FERS, you can retire at any age with a minimum of 18 months of creditable civilian service. You must be able to perform useful and efficient service in your current position, and this is important. You must have become disabled while you were in that FERS position. If you came into the government with a disability and go out on a disability related to that, you wouldn't be covered under disability retirement. You must be able to find a vacant position in your current agency at the same grade or pay level within your same commuting area. You must be expected to be disabled for at least a year. You must apply prior to separation or within a year thereafter. That's very important as well. And finally, because you're covered under FICA, you have to apply for Social Security disability benefits. Deferred retirement under FERS, you can see from this chart here that you have to meet minimum age and service requirements. These are the same as for the prior voluntary retirement, with the exception of that MRA plus 10 that we've already discussed. And here with deferred retirement annuities, here are considerations and conditions to meet if you do not want your annuity reduced. So it's important to make sure that you're considering all of these options and stipulations to make sure that your annuity is reduced as little or not at all as possible. And here is the FERS annuity formula, where you can see that if you're under age 62 at separation, or you're 62 or older with less than 20 years of service, your formula is 1% of your high 3 average salary for each year of service. And then if you meet the requirements here, it's actually calculated at 1.1% of your high 3 average salary. Reductions to FERS annuity are similar to CSRS, except that you also have the potential reduction for the CSRS components. Employees that had to move over to the FERS system, they might have components there that would impact their age, whether they made deposits or redeposits, so that would all impact your annuity. And the survivor benefits are the same as what Sharon covered under CSRS. And as Sharon mentioned, the best date to retire under the FERS system is the last day of the month, because your annuity will start the very next day. Any other day of the month, you're going to wind up losing pay because you'll be between your last paycheck and your first annuity payment. And now I'm going to turn it over to Anthony Spates, who will discuss TSP and Social Security benefits.
Hello, everyone. The Thrift Savings Plan. This is the federal government's additional section of the Federal Employees Retirement System. It's very similar to the private sector's 401k plan. So as an employee that's eligible for TSP, you are able to control the amount that you contribute, which then returns the amount you receive later on as part of your annuity. So both FERS and CSRS employees are automatically vested. The agency contributions are only vested for the FERS employees. The agency automatic contributions, the 1%, is for FERS employees only, and that's after 3 years. So each year, there's a maximum amount that you can contribute to TSP, and for 2015, it's $18,000. Okay, TSP contributions. So there is a matching contribution available through TSP. It's basically dollar for dollar up to the first 3% and 50 cents on the dollar for 4 and 5%, and no matching contributions after 5%. So if you contribute 5% or more of your overall pay, you earn a 5% match. So as a new employee, FERS or a CSRS employee that's newly hired with more than a 30-day break, you're automatically enrolled in 3% deduction of your pay into TSP. Those funds are automatically contributed to the Government Securities Investment Fund, which is the G Fund, and you can reallocate that money by going to tsp.gov or using the TSP1 election form, which can also be used to stop your contributions as well. So there are various types of funds available through TSP. You have your Government Securities Investment Fund. Then you have other index funds, your F, C, S, and I. And the C fund, the Common Stock Index, it mirrors the S&P 500. You also have the Life Cycle, which is the L fund. And this basically allows you to manage your TSP by kind of mirroring your retirement date. So the L fund is available for maturity at 2020, 2030, 2040, and 2050. So it starts off very high risk early on, and as it gets close to the maturity date, then it becomes very conservative. So the Roth option of TSP, the contributions and the earnings are after tax, so you will never be subject to additional tax on that. And you can enroll in the Roth option by using the TSP1 or logging in through Employee Express. If your only salary deductions are placed in the Roth TSP, your agency will provide the same matching contributions as they would for the traditional. Rollover and transfers. You can roll over or transfer money from a prior employee's qualified plan or an IRA into TSP using the TSP Form 60. TSP cannot accept transfers from Roth IRAs. So at the age of 50, the TSP has an option to allow for match-up contributions, or catch-up contributions. And to be eligible for that, you must have reached the maximum eligible to contribute to TSP for that year, and you can enroll in the catch-up contributions. The limit on the catch-up contributions is $6,000 for 2015. Once you reach that max, then your contributions will automatically be stopped. TSP loans. So if you have at least $1,000 of your own money in your TSP account, you can apply for a TSP loan. The principal and the interest go back into your TSP account, and you can go to tsp.gov and find out more information on the current interest rates and also payback of TSP loans. Also on tsp.gov, you can find information on the fund allocation and make your loan request there. Now, Employee Express is available to do enrollments, cancellations, and changes to contribution rates. Social Security. So Social Security basically has four components, which includes retirement benefits, family benefits, disability benefits, and health insurance. The old age survivors and disability insurance consist of retirement, family, and disability benefits. Health insurance benefits are covered under Medicare and Medicaid. So for the employees that are contributing to Social Security, it's a rate of 6.2% of their salary. FERS and CSRS offset employees are eligible for Social Security benefits. Your CSRS only employees are not eligible because they never pay taxes to Social Security. And all employees pay 1.5% of their salaries toward Medicare. All federal employees are eligible for Medicare benefits. Agencies match all Social Security and Medicare contributions on a dollar-for-dollar basis. So retirement benefits eligibility. So working and having Social Security taxes withheld earns credit. So if you were born after 1929, which should be most of our workforce, you need 40 credits to retire and receive benefits. 4 credits can be earned per year. So in 2015, you earn 1 credit for every $1,220 earned. To receive full benefits, individuals must retire at full retirement age and have 40 credits. And the chart below basically describes the full retirement age based on the year of birth. Retirement benefit considerations. So you can start receiving benefits as early as age 62, but your annuity will be reduced. You can start receiving benefits as late as 70, and the annuity will be higher than if you started receiving benefits at full retirement age. Your benefits are reduced by $1 for every $2 earned above the earnings limit. The earnings limit for 2015 is $1,290 per month or $15,480 per year. The MyRA, My Retirement Account. So this is something that's offered by the Department of Treasury, and it's for individuals who are not eligible to participate in any type of employer retirement plan. So that would include employees like those that are temporary, seasonal, intermittent, and non-federal, or your contractors. This is a type of Roth IRA, so there are no startup costs, there are no fees, and there are no risks. All of the money contributed to the MyRA goes into the G Fund. There's no minimum contribution amount. The maximum that you can contribute is $5,500 with a $15,000 max for the account. Withdrawal contributions. You can withdraw contributions at any time without any tax or penalty. Withdraw interest without tax or penalty in certain circumstances, such as retirement or the purchase of your first home. Insurance after non-retirement separation. So when you separate from the federal government, your FEHB, your health insurance coverage, will end on the last day of the pay period in which separation occurs. Then your agency extends it for 31 days at no cost to you. Then you can elect temporary continuation of coverage, TCC, for 18 months or convert to an individual policy. The dental and vision insurance ends the last day of the pay period in which the separation occurs. There is no option for continuation with this. The FSA says you can no longer make contributions to this after you separate, but you can submit claims as long as you have an account balance. FEGLI, the life insurance, ends on the last day of separation. Then your agency extends it for 31 days at no cost to you. Then you can elect to convert to an individual policy. The Federal Long-Term Care Insurance Program, continues after separation if you continue to pay the premiums. Accounts as a non-retirement separation. So with CSRS, there are two options. You can receive a refund for your contributions, or you can leave in CSRS fund and receive annuity later. FERS, you can receive a refund for your contribution or leave in FERS fund and receive annuity later if eligible. TSP, the three options are you can do nothing and it will continue to grow and earn interest. Or you may decide to cash it out, but be aware that you will pay taxes and possible penalties. Roll it over. You can roll it over into a IRA or another employer's qualified plan. Your Social Security will remain in the Social Security system until you apply for retirement benefits. FEHB in retirement. So to continue FEHB coverage in retirement, you must be entitled to retire on an immediate annuity under a retirement system for civilian employees, and that including FERS with a maximum retirement age plus 10 retirements, and have continuously enrolled in a FEHB plan for the 5 years of service immediately before the date your annuity starts, or for the full periods of service since your first opportunity to enroll. If you qualify for MRA plus 10 and decide to postpone receiving annuity, FEHB will end the fund separation. You will be entitled to TCC and conversion rights. You can re-enroll in FEHB within 60 days of annuity beginning. FEGLI in retirement. So to continue the FEGLI coverage into retirement, you must be entitled to retire on an immediate annuity under CSRS or FERS. Be insured for the 5 years of service immediately before the date your annuity starts, or for the full periods of service during which you are eligible to be insured. If less than 5 years, called the all opportunity requirement, and have not converted your life insurance coverage to an individual policy, or if you had already converted to the coverage, you cancel the converted policy. The same conditions apply if you want to carry optional insurance into retirement. So this is a list of resources for additional information on insurance. And we also have additional resources for information on retirement, as well as the GSA website and OPM. This concludes our retirement and benefits training seminar. If you have any further questions, please contact your agency POC or email gsacabs@gsa.gov. Thank you for your participation.